So glad you are with us on the Allon Exchange. Brad Johansson with Jay and Brittany Hagee, Allon Planning Partners, and it is always great to be with you guys.
Always
You too,
great to see you, Brad.
How are you?
Doing great. How are you?
Good.
Good.
Dealing with the change, right?
Yeah.
We talk about this all the time. And for a lot of you, as you move into retirement or talking about retirement, you're trying to figure out, what's my risk level? Where am I? Am I taking too much risk? Am I taking too little risk? Do I know how much risk is in my portfolio? I want to spend this half hour kind of talking about risk and safety and growth and finding the balance, right? I mean, in life, we're always trying to find the balance. You guys
Is that
are
possible?
with your kids.
I don't know.
Sometimes then it's with your parents. We're in a lot of people in the sandwich generation where we're trying to manage.
Both
I don't have
ends.
time for all of this. And certainly with my finances, I'm just hoping that it's going to be okay. We've said this many times, hope is not a plan. So I want to get into the planning stage. Can you lead me into the foundation of where we manage our risk, Jay?
Well, risk is something you have to talk about, especially entering in retirement. If you're in retirement, you have to understand that risk isn't always the enemy. The wrong type of risk is the enemy, because you're going to face risks no matter what you do, right? Too little risk and you'll quietly suffocate your portfolio. And too much risk, well, you'll blow it up, right? So it looks different, but you do need to find the structure of balancing that risk reward. I often have clients even come in and tell me, Jay, I don't want any risk at all in my portfolio. And I say, well, that's okay until you realize that inflation at 3 to 4 to 5% a year is eating it away. And so the risk you are now seeing is you're not able to buy the things 5 years from now that you bought today at the same dollar rate. So you're always going to have risk. The question is not how do I eliminate all risk? It's about how do I make the appropriate risk structure for my portfolio, for my retirement accounts, for my income. And we're going to talk about all that today, but we need to balance too much risk to too little risk, and where do I fall in between to make the right recipe for what I need to make it through retirement.
The risk that your client talks about, I don't want to be in any risk. In the mind of the client, for most, it's my risk
Market
is in the
risk.
volatility of the market, right?
Yeah, that's where a lot of people think that is the only risk they've got, right? Market risk. I don't want my money at risk. Again, risk is unavoidable. So Jay already mentioned things like, inflation and how that really impacts your purchasing power, and your dollars today are worth less than they were yesterday. So that's absolutely a risk for holding too much cash, right? So you're looking at longevity risk. That's another thing. We're living so much longer. We have to make what we have last longer. And you've got even things like interest rate risk. Some people will say, well, CDs are safe, right? Let me just put all my money in CDs. Well, you've got interest rate risk. You have a fixed interest rate with those accounts. And as the economic cycle changes and the interest rates change, you are going to absolutely be impacted by that. And you'll be in a position where you have less, you're making less on those. There's all these types of risk. But here's the point. You get to choose the amount of risk and the type of risk that you're willing to take. We've all got them. You can't avoid them, but you do get to choose the amount of risk and the type of risk you're going to take. But that requires, being proactive and actually looking at that, actually planning for that, and not letting it happen to you.
And when it comes to our portfolios and our retirement accounts, let me explain the biggest risk that most of us have. And it's between our ears. It's right here. The biggest risk we face is we're too smart for our own good sometimes, right? Is because I can logically time when I'm getting in and out of the market, or I know how much volatility I'm supposed to take here or there. Poor emotional decisions when it comes to market timing and trying to beat the market returns and things like this can account for 50% of the bad mistakes that you're going to make in retirement. So that's why we say let someone come alongside you and coach you through these things. It's not that you're doing a bad job or you can't understand it or you're not smart enough. It's that we make emotional decisions sometimes because our money is emotional, and it can be detrimental to our longevity of our retirement plan because the risk between our two ears tells us we got to jump all in because I'm going to miss out on the greatest return ever,
Yeah.
or I have to pull all out because I'm scared I'm going to lose everything. That will happen to you if it's not happened already. It will happen to you at some point in your journey. That's where we step in and help.
Well, and get a bigger, a better, bigger picture, right? To actually kind of take a higher level view of where you are and assess the entire situation and not look at it just like as individual silos, but look at the whole picture. Let's take the 10,000-foot view. That's what we do. We're looking at all of these pieces and how they work together, how your risk and investments work together, how the risk levels you take impact your income as you're going through retirement. All of these things coexist, and we want them to coordinate, not fight against one another. So we'll help take that 10,000-foot view.
Okay, let's take the 10,000-foot view. We talk about two different things: risk tolerance, maybe a feelings test, and risk capacity. Can we afford to? So you talk about the feelings in between the ears. Can you have people come in, and I know you do this regularly, so I'm answering my own question, but can people walk in and take a test to say, all right, how do I feel about my risk? And then let's assess by your feelings where your investments lie and what's in your portfolio, and are those two things matching?
Yeah, and that's why we talk a lot about risk capacity, because capacity speaks to what your plan can actually handle. You know, the capacity that your plan has for risk versus how I feel my risk tolerance is. Like, I feel like I can stomach all the market volatility.
Right.
That doesn't mean that you should, right? Because your plan may not be able to handle what your emotions can handle, and vice versa. You may be in the situation where I can't stomach any losses, but your plan says, I need you to take some risk, right, in order to get to where you want to be. So we have to look at risk capacity versus just risk tolerance. Risk tolerance is always important because that says what I can tolerate emotionally. But capacity says, hey, from the plan that we put together, here's the risk that's dictated to get you to the next level.
Well, and the practical implication of that is a lot of times we'll sit down with folks and we'll look at their statements and we'll take an assessment of where they are, taking that 10,000-foot view, but we're looking specifically at investments, and we'll talk about what is your comfort level when it comes to risk. What does that actually look like with regard to market risk? I'm really conservative. I'm extremely conservative. We take a look at the statements and then how they're actually investing their dollars, and so much of the time, their preference does not align with their investment strategy. That's the difference. There's a disconnect between the two.
Yeah, I've got to tell a quick story on that, because
please.
Here's the deal. Higher risk doesn't always equal higher return.
Yeah.
Because that's what we're taught. That's what there I go again, the risk between my ears. Because I believe the more risk I take, the more return I'm going to get, which is a possibility, not the truth. Sometimes more risk can equal more regret. And that's what I was trying to get to. We had a client come in. It wasn't even a client at this point, but they were talking about the latest crypto investment that was the hottest crypto coin that was out there, right? And they said, I want to put all of my IRA dollars into this crypto coin. I took a step back, and that was one of the moments where I said, what your stomach can handle in volatility doesn't mean your plan should handle that, right? And I tried to explain the difference in risk reward. Well, there was no talking them out of this. They really wanted someone just to confirm with them, say, yes, you should be in this crypto coin. But they didn't get my blessing. I told them we need to create a plan to where you have diversification, not just one coin. They took all the risk, and unfortunately, about 3 months later, that crypto coin lost about 70% of its value. And they put all of their IRA dollars in that. And so it doesn't always mean higher risk, higher reward. You sometimes have to live with the regrets because you think you can stomach more volatility than you can. And so we want to help balance those two approaches. We want to say, how do I take appropriate amounts of risk, and how does my plan dictate the risk capacity that I have, not just the risk tolerance that I feel, whether it's I want to take too little risk or I want to take all the risk there is. How does your plan speak to risk capacity? And that's what we help you put together. And one place to start is allonquiz.com. Because if you take this quiz, it's going to explain to you just a few pieces of information that you put in. It's going to explain to you where you're at on this journey of getting a roadmap to understanding how much risk should I be taking in retirement. So we want folks to fill out that allonquiz.com so that you can understand where should I begin on this journey when it comes to risk.
Do you have any idea what your risk tolerance is? Do you have any idea what your risk capacity is? Maybe it's quiz time. You can't fail this one. Knowledge is power. Where is my starting line? Where do I need to be? Are there questions that need to be answered? You can go to allonquiz.com, the website, or you can just simply scan the QR code on your screen. Let's get started. Where are you on the risk meter? Let's put together a complimentary plan for you. Once you go to this, you're going to want to call the number or scan the QR code. Let's get together and work now, because maybe what you're feeling isn't what the reality is. Let's work together. Be right back. Just a minute with Allon Planning Partners, Brad Johansson, Jay Hagee. What are the risks in retirement, Jay?
I think that's a good question, Brad. You know, there are many risks in retirement, whether it's market volatility or inflation that we've seen, or healthcare or longevity, us living longer than ever before. But the real question behind that question, I believe, is how do we avoid those risks in retirement?
Answer?
Here's the answer. You have a proper holistic plan. What does that look like? You have 5 components that you need to cover: investment management, income planning, tax planning, got to keep the money away from Uncle Sam when we can.
Heck yeah.
Estate planning, and then you have to worry about healthcare planning, because any one of these 5 dominoes can take out one of the other ones. So you want to avoid all risk, if at all possible, and make sure that you have a comprehensive plan to approach retirement.
Manage your risks with a plan. Just a minute with Allon could change everything.
You've worked hard for your money, so it just makes sense that you would like to keep as much of it as possible. At Allon Planning Partners, we can help you avoid common tax mistakes. We'll work with you to minimize your tax burden in an effort to maximize your income in retirement. We will ensure that you have a comprehensive written financial plan. Call the number you see here for your complimentary consultation.
So glad you're with us on the Allon Exchange. Brad Johansson with Jay and Brittany Hagee, and we're talking risk today. Let's get into safety, Brittany. When people hear safety in finance, it's, for a lot of people, I'm going to hide my money under the mattress. Yeah. That's safe. What does safety actually mean?
Well, we're trying to strike this right balance. That's where we started this conversation today, right? With risk, safety, growth. How do we do all of those things at the same time? That's the conundrum we're in, trying to figure all that out. Well, part of our approach is looking at segmenting your money, okay? So that all of your money is not invested the same way. This is what we find a lot of times folks have a 401k or an IRA, and all of their retirement or investment dollars are invested the same way, right? And moving the same direction at the same time. So what we want to do is really kind of segment that money out. So where maybe you have 3 different buckets, so to speak, of money that have different investment type strategies for each of those. When we're talking about safety, we can begin with that bucket, the safe bucket. This is what you would say, this is like what I have to have, like baseline to live on, like minimum, bare minimum. This is like what's going to pay my bills next month. This is what I've got to have. That is invested one way. You're not going to take that and put that in a very high risk, all equity type portfolio, because that is like non-negotiable. I got to have this money to pay my bills, right? You want to look at another, maybe midterm and long-term. So you've got immediate, hey, this is what I need for money now. And then you've got midterm and long-term. So you've got these 3 different buckets that are all invested in different ways based on the purpose of your dollars. This is where the whole purpose-based planning concept comes into play for us. This is the basis of why we plan and strategize the way we do, built around your purposes, midterm, long-term, short-term.
And for me, it's saying that not all my money has the same job. The money that I'm using to buy my groceries this week shouldn't be 100% in the stock market, right? Because I have to eat this week,
Right.
or I have to clothe my children in the next month. So the money that I'm going to take to the mall to buy shoes for Johnny shouldn't be in the stock market, right? Every piece of money should have its own job. And so short-term buckets, we usually say, 1 to 2 years when you're in retirement of immediate income should be in a more short-term bucket so that you're buying things like groceries and your everyday expenses. So it may be more in fixed income where you're just drawing interest off that money, right? So it's still growing, it's still working.
Sure.
It's just not as active as a full equity bucket. All the way down the road to the long-term 20-year bucket that says, I want to take more risk with this bucket because I know that inflation happens year over year so that things get more expensive. And I need that long-term bucket to perform over time, not in the next 2 years, not in the next 3 or 5 years, in the next 20 years, so that I have that money to live on and refill the buckets that I'm using now. Not all money has the same job. And so we have to segment it, like Brittany said, so that we have different buckets for different opportunities.
Well, and people who want that, crave that safety, crave that like protection with their money, avoid that long-term bucket. They avoid the long-term bucket because they're like, well, I don't want to take any risk. I don't want
There's
any
a
market
cost.
risk. But there is a cost to not doing that, because you will end up having your dollars being able to not go as far, right, as you had planned on. You're going to end up in a position where you don't have what you need for that. So there is a cost to not taking enough risk when you're considering inflation and what that actually looks like. So you really do have to blend all of that together. Now, we're not saying that long-term bucket needs to be at 100% market risk. We're not saying that either. There's still, we can minimize risk in that bucket, still hold some risk, but have just enough to allow for growth to keep up at least with inflation so that you're not losing on your dollars.
And what Brittany's saying is safety should support confidence, not create complacency. Because it should make me more confident that I'm not going to run out of money, but it doesn't create this complacency to say I can put all of my money under the mattress, right? Because we do have to have that money still growing, because inflation is a silent killer. Inflation, it says you don't really feel it until you can't pay for it anymore. Like, you don't feel it eating away your purchasing power until you're 15 years down the road and realize that at a 3% inflation rate, the cost of living, what it takes you to live today, doubles every 24 years. The average retirement's around 30 years. So that means if you're making $100,000 today in your retirement account, that I just have to live on $100,000, within 24 years at 3% inflation, that's going to be $200,000 that I have to have. So if I haven't had the proper growth in my accounts, I'm going to run out of money at some point.
Well, and that's with 3% inflation, which we have not experienced 3%
Not
inflation,
recently.
right? Recently, it's been much higher, which means your 24 years is cut down to, you're looking at 12, something like that. So think about having to double your income
in retirement
every 12 years in retirement just to maintain your lifestyle.
Yeah, the numbers that we've seen even in just the last 5 years since COVID hit, it's now 25% higher for us to live. And it goes against what Mom said. Mom always says you can never be too safe. The thing with finances now is you can be too safe if we don't, as you say, segment the money. So we're in that mode of, okay, allonquiz.com. Where am I on risk? Where am I on safety? How do I feel about all of this? And as I answer these questions very quickly, scan the QR code and say, where's my starting point? Maybe I have been too safe. Maybe I've been too risky. Maybe I need some help to try and find that beautiful middle. Jay and Brittany do this every day, and their team puts together a plan that is just for you. You've been waiting for a while. Are you ready to call? Make the call now. Scan the QR code. Let's put together a complimentary financial plan that weighs your risk, that weighs your safety, that works on a potential 30-year retirement so money is going to last until your last breath. Let's do it now. You're watching the Allon Exchange for a reason. Do something for yourself. Be right back. Just a minute with Allon Planning Partners, Brad Johansson, Jay Hagee. How do we best diversify in retirement?
I think Warren Buffett said it best. Investing is simple, it's not easy. The reason it's simple is you only have 5 asset classes that you can invest in. It's not easy because you have to determine where should I be in certain times in each of those asset classes. You want to make sure that you're looking into stocks, which are equities in companies, bonds, which are the debts of companies or countries, commodities, things like gold and oil and wheat, maybe even crypto at this point in the game. You want to make sure you have real estate in your portfolio and cash, whether that's under your mattress or in the bank. But you want to make sure you're fully diversified between those 5 asset classes.
So you've got a plan for diversification. Just a minute with Allon could change everything. So glad you're with us on the Allon Exchange. Brad Johansson along with Jane Brittany Hagee, and we're talking about risk. We're talking about safety. We're talking about figuring this whole thing out. But that means I have to worry about growth.
Yeah.
See, for a lot of people in the financial world, growth feels like risk. If I have to try and grow, I can't sleep at night because I'm worried about it. Take me through the growth process.
Well, absolutely, because before we went to break, we were talking about the risk balance that we're talking here, and it's really the balance between safety and growth, right? That's what the seesaw is here. And to make sure that we have perfect balance in that, it's really going to be hard. But over time, we find the balance between the safety and growth really easily as we look at the whole plan, right? You have to make sure that I'm looking at every income bucket that you have, every income producer that you have, and every allocation model that you're in. One thing that really helps with the growth is you don't have to fear it if you have enough diversification. Diversification is really the magic tool because you're a baseball guy, right?
Yes.
Like you like baseball.
My boy's a baseball guy, so I have to be a baseball guy. Yeah.
And so it's not always about hitting home runs. Not every play has to be a home run.
Correct.
But what it is about is avoiding strikeouts.
Yes.
Because if I can avoid strikeouts and get on the base and just get on the base and just get on the base, by the time I do that 3 or 4 times, I've scored a run, right? And so diversification is about the base hit, the second base hit, the triple every now and then. It's not always the home run, right? But it's about moving the ball.
Yeah.
Moving the ball. And so we want to make sure that we diversify so we don't totally eliminate risk, but we can spread it out so that nothing breaks you.
So let me give you a visual for that. So think about diversification. Another term we use when we're talking about all this is correlation. How are your investments correlated? How are they working with one another? So what we want to avoid is all of your investments moving in the same direction at the same time. Correlation. So get this image in your head. Think of grandma's old quilts, right? The patchwork quilt with the squares, what that looks like, all the different colors. That's really what you're looking for, the variety of colors in the quilt that's your grandma's old quilt. What you don't want is for it to look all the same color. You don't want it to all be even shades of the same color. You want there to be some real diversification, some real change in color. You want to have some of those really strong equities, that produce that growth. Then you also want some of those, more or I should say less market risk investments that will, maybe some bonds or some things like that will counteract that. So you're really wanting all of those bright colors. You're wanting the variety of options when it comes to that quilt. So you don't want all of your investments moving the same direction at the same time.
Well, and even in just your equity basket alone, there are 11 to 15 sectors, right? Maybe we have some in healthcare, some in utilities, some in consumer staples, some in technology, right? You can diversify within even the equity basket. So it's not that you have to have polar opposite things, which is good to have, but you can also have diversification within one basket. And this balance that we're talking about, it really doesn't happen by accident. It's by design. We're helping design this balance of risk, safety, and growth for every client that comes in. And we offer complimentary consultations every week because you may be stuck in a mode where you're like, I don't really know what that looks like for my situation and my portfolio. We can dig through your income needs. We can dig through your spending plan. We can dig through your portfolio and analyze that and see, how am I positioned? Because sometimes people come in and they are taking way more risk than they think they are. And sometimes they're not taking near enough risk. And how do we help create a portfolio that's not only going to last today, but last for years and years to come throughout retirement. So what we want to do is offer that to you, the QR code and the number there on the screen. We would love to sit with you and your family and design this balance on purpose, not by accident, but actually design how much risk you should take, how much safety you should be in, so that you don't have to go to bed tonight and wonder what if and hope.
Right, yeah. And I also want to kind of hit the concept of what diversification is not. Because we'll have folks come in and we'll sit down and look at their situation, look at their statements, and they'll say, well, I'm really diversified. I have 47 different mutual funds within my portfolio.
Yeah.
But the problem is all of those mutual funds are invested in the same holdings, right? The same components are in each of those, and so they are all moving the same direction. That's not diversification. Diversification is within, as Jay mentioned earlier, talking about the diversification even within the same sectors, within equities, looking at the different healthcare and energy, all of these tech, all of these different things, and ensuring that true diversification is happening, not what you think might be diversification, but true diversification.
Yeah, I have a note here that says a written income plan reduces retirement anxiety by 50%. You talk about the domino effect all the time, putting the puzzle pieces together, and it is a puzzle. And a different puzzle for every single person. But being able to see, oh man, I have a plan.
I don't have to think about how I'm going to pay the electric bill this month. Yeah, that should let you breathe. Having a true income plan should give you that sleep well at night plan, was what we call it. And so the SWAN plan. We want to make sure that you have what you need, understanding that it's not just for today, but it's for years and years to come throughout retirement. And that income plan, if we can cover that, then we can handle any market volatility because we know we have what we need to get through the day-to-day.
This is your time now. Make the phone call, scan the QR code. You want one of those? Let's help you put it together. Because it's your time, and this time we hope is going to last for decades on a retirement plan that works just for you, something that eases the anxiety, that measures between the risk and the safety, just the right place to be. At Allon Planning Partners, that's what they do every day, and yours is going to be different than anybody else's. So stop waiting. Make today the day. Make the call. Scan the QR code. We can't wait to see you in the office, and right back here next time on the Allon Exchange.